Hi everyone, this is Paul Garrard. I'm founder and president of PGPresents, an independent student loan consulting company. We've put together a series of repayment modules designed to help you guys do a better job of managing your student loans after you graduate and move into your training programs and then ultimately as attending physicians. In module number 3, we looked at how the income-driven repayment plans work. This is module number 4, where we take a detailed look at the differences between pay-as-you-earn, known as PAYE, and revised pay-as-you-earn, known as REPAYE. Hopefully, this will help you know that if you're going to use an income plan, which of these plans will be the best one for you. Now, on our homepage, pgpresents.com, there is a comprehensive comparison chart of the income plans, including the older plan known as income-based repayment, or IBR. What we've done here is we've taken a snapshot of some of the most important differences between the newer plans, pay-as-you-earn, and revised pay-as-you-earn, to help you decide which of these two plans would be best for you. We would encourage you, if you're going to use an income plan, look at the full comparison chart and go line by line and look at the differences in the plans to help you determine which of those apply to you and therefore which plan might be best for you as you enter repayment. So we're going to look at some of the most important differences between pay and repay. First of all, pay-as-you-earn became available in December 2012, so it's a bit older. Revised pay-as-you-earn, known as REPAYE, became available in December 2015, so it is easily the newest repayment plan under the income-driven repayment plan umbrella. Note the payment calculation is done exactly the same with pay and repay. Both are calculated at 10% of discretionary income, but there's an important difference that may apply to some of you. With pay-as-you-earn, you will never be kicked out of the plan, even if your income jumps up dramatically. At some point, if your income gets high enough so that you no longer meet a threshold for pay that's called partial financial hardship, that's just a threshold that looks at your income, family size, and the poverty level for the state that you are living in. At some point, if your income gets high enough and you don't meet that threshold anymore, you're not kicked out of pay, but your monthly payment under pay is simply capped, or it maxes out at what you would have paid under the original standard 10-year plan. So with pay-as-you-earn, there's a provision that says you will never be required to pay more under this plan than you would have under the original standard 10-year repayment plan amount. There's no such cap with REPAYE. You always pay 10% of discretionary income. Note the difference in repayment term. With pay-as-you-earn, it's 20 years. With REPAYE, it's 25. That simply means that with pay, you've got 20 years to retire the balance, and with REPAYE, you have 25 years to retire the balance. Now, very important note for those of you who are married or thinking about getting married, and we do have a separate module for married borrowers. Under both of these plans, spousal income will be counted in the determination of the monthly payment amount. By the way, federal debt of your spouse will be counted as well if their income is being counted. But notice a big difference. With pay-as-you-earn, if you need to exclude your spouse's income from the monthly payment calculation, you can do that with pay-as-you-earn by filing a separate tax return. With REPAYE, spousal income is always counted. And the last difference is a very important one, the interest subsidy on unsubsidized loans. We mean direct unsubsidized and direct plus loans. REPAYE has a provision that simply says the government will allow negative amortization. This is where the monthly payment with REPAYE is less than the interest you owe, but they will cut it or subsidize it in half. A simple example. Let's suppose that the interest you owe is $1,000 a month just to keep your balance where it is, and your REPAYE payment is calculated at $300 a month. That simply means you're going into the hole $700 every single month. That's called negative amortization. With REPAYE, the government will cut that in half. In other words, negative amortization will occur, but only at $350 a month. Folks, the easiest way to think about this is that the government slows down how fast your debt will grow under REPAYE anytime the interest you owe exceeds the calculated monthly payment amount under REPAYE. Clearly, someone who has a large gap between what they owe and their income, this would benefit them. So some very important differences between pay and repay. So which plan will be best for you, pay-as-you-earn or revised pay-as-you-earn? Once again, we'd encourage you to take a look at the comprehensive comparison chart on our homepage and go line by line and look at the differences in the plans and see which ones apply to you and which ones do not. Hopefully that will help you know which is going to be the best plan for you. These are some general statements based on some of the borrowers that we have worked with. Pay-as-you-earn may be best for borrowers who are going to have a big income jump right after training, because remember, with pay-as-you-earn, you have to meet this threshold called partial financial hardship in order to qualify. And at some point, if your income gets high enough, you won't meet that anymore. But you're not kicked out of pay. Your monthly payment still under the pay-as-you-earn plan simply maxes out or is capped at the original standard 10-year payment amount. You're not put into the standard 10-year plan. Your monthly payment in pay just maxes out at that original amount. You can overpay if you want to, but certainly if you're trying to qualify for the Public Service Loan Forgiveness Program, you will not want to at that point. Pay-as-you-earn will be needed for someone who's married and has to exclude spousal income from the calculation of monthly payments, because remember, the only way to do that is to file a separate return and use pay-as-you-earn, because REPAYE always counts spousal income. And remember that pay-as-you-earn has a 20-year term compared to a 25-year term with REPAYE. So if your debt is really large and you don't think you'll ever retire it, and you're not going to be using the Public Service Loan Forgiveness Program to retire your debt, pay-as-you-earn would allow you to be debt-free at year 20, 5 years earlier than with revised pay-as-you-earn. The downside of that is that you would face a higher potential tax bill because you would owe more in terms of forgiveness than compared with REPAYE if you've paid for 5 more years. REPAYE is probably best for borrowers who have a really big gap between debt and income and may have that for a long time, because remember, that's where that 50% subsidy will help. The government will slow down how fast your debt grows anytime the interest you owe exceeds your calculated monthly payment amount with REPAYE. REPAYE is also probably best for someone who's single and doesn't have to worry about spousal income, or whose spouse has relatively low income. So some takeaways as we close up this module on pay versus repay. They're both good plans. It's unlikely you're going to make a bad decision choosing either one of these. And remember, you can switch plans. For example, if you're single and you choose REPAYE to take advantage of the subsidy, and at some point perhaps you marry into money and you need to exclude your spouse's income from the calculation, you could switch to pay-as-you-earn and file a separate return at that time. Once again, go through the differences in the programs and just see which one happens to suit you the best. But whatever you do, when you apply for an income-driven repayment plan, do not let your loan servicer select the plan for you. And here is yet another reminder: if you use an income plan, do not miss the renewal deadline. Otherwise, your monthly payment will jump up dramatically and interest is likely to capitalize on your loans. This is the end of module number 4.